All right, let's get right into it. We're looking at a really strange situation facing the U.S. Federal Reserve. I mean, they're on the verge of making one of their most important decisions of the year, but they're essentially doing it blindfolded. And that's the central mystery, right? You've got the world's most data-obsessed financial institution, and it has to make a huge call on interest rates without the very data it needs most. So how on earth are they going to pull this off? Let's break it down. So yeah, we're diving into the Fed's big dilemma. How to make monetary policy when you don't have the data. Okay, first things first, let's just quickly get on the same page about who we're talking about. It's the FOMC, the Federal Open Market Committee. This is the group inside the Fed that meets 8 times a year to basically set the course for the entire U.S. economy by deciding the key interest rate. And their next big meeting, it's coming right up on October 28th and 29th. Now here's the heart of the problem. That U.S. government shutdown that kicked off on October 1st, well, it completely stopped the flow of the economic stats the Fed depends on. It's like a pilot flying a plane through a storm and suddenly all their instruments go dark. The big one, the September jobs report, it was never even published. So what was the last thing the Fed saw on its radar before everything went black? Let's look at the final signals they got from the labor market, because this really builds the case for what they're probably going to do next. And the first clue was a real shocker. The August jobs report showed that the economy added only 22,000 jobs. Now, to put that in perspective, everyone was expecting something like 75,000. So this was just a fraction of that, and it suggested the job market was already hitting a wall way before the shutdown even began. And on top of that, the unemployment rate ticked up to 4.3%. That's the highest it's been in almost 4 years. This hits right at one half of the Fed's main job, keeping employment as high as possible. So it wasn't just that job creation was slowing down. More people were actually out there looking for work and just not finding it. And if you dig just a little deeper, the picture gets even worse. The last JOLTS report, which is all about job openings, showed they were at a 5-year low. But here's the real kicker. The rate of actual hiring fell to its lowest point since 2013. That's a level we haven't seen since the dark days right after the 2008 financial crisis. I mean, that is a huge red flag. Okay, so with no new official numbers coming in, the Fed has to start looking for other signals, right? They've got to navigate somehow. So what are the markets thinking? What are the big banks saying? How is everyone else interpreting this silence? Well, the market has definitely made up its mind. If you look at the CME FedWatch tool, which is basically a big poll of what traders are betting on, they see a rate cut as practically a done deal. They've priced in a staggering 98% probability of a cut. And, when market expectations get that strong, it almost becomes a data point all on its own. And hey, it's not just the traders. The big Wall Street banks have formed this incredibly strong consensus. You've got Goldman Sachs, JP Morgan, Morgan Stanley, Bank of America. They're all singing the same tune. Now, they might disagree a bit on what happens down the road, but for this October meeting, they are all pointing in the exact same direction. A rate cut is coming. This brings us to a really sharp insight from Krishna Guha, who used to be a big deal at the New York Fed. He points out that, kind of paradoxically, the lack of data actually makes a rate cut more of a sure thing. And this really gets to the heart of how central banks think these days. When you're faced with a ton of uncertainty, your default move is to manage risk. The shutdown itself becomes a reason to act. Okay, so the market is convinced. But what about the people who actually have to vote on this? Let's try to read the tea leaves and see if we can find some clues from inside the Fed itself. And luckily, some recent speeches have given us a pretty clear window into what they're thinking. Fed Governor Christopher Waller has been about as blunt as a central banker ever gets. Just on October 17th, he came right out and said he'd support a cut. But he also admitted there's a puzzle going on. The economy looks strong in some ways, but the labor market is clearly getting weaker. And as he put it, something has to give. And just a couple of days before that, the big boss himself, Fed Chair Jerome Powell, signaled a pretty big shift in his thinking. He said flat out that the risks to employment have increased. And then he said policy might need to take another step towards a more neutral stance, which, that's just Fed speak for we need to lower interest rates from where they are right now. So when you put all these clues together, you've got the bad data before the blackout, you've got this unified expectation from the market, and you have these signals from the Fed's own leadership. Two competing stories start to emerge to explain what's about to happen. Let's look at these two hypotheses.
On the one hand, you have Hypothesis 1. This is a smart, preemptive move. The Fed sees the labor market getting weaker, and they're acting cautiously to head off a downturn, especially since they're flying blind. But on the other hand, you have Hypothesis 2, which is a bit more cynical. It says the Fed is just caving to all the pressure from politicians and the markets, cutting rates even though things like GDP are still fine. And the risk there? The Fed could really damage its credibility in the long run.
So, which of these stories actually holds up? Let's weigh the evidence we've just walked through and figure out which hypothesis makes the most sense. When you really look at all the facts, the idea that this is a preemptive, prudent move to protect the economy just seems more likely. The slowdown in the job market isn't just one bad number. It's a clear trend across a bunch of different reports. The reasons that Waller and Powell gave are logical, and they're based on that data. Plus, the fact that pretty much every major bank agrees, well, that adds a lot of weight. Now, the criticisms about pressure are totally valid, but the data really seems to back up the Fed's cautious stance here. So I think the bottom line is this. When you are flying blind, you ease off the accelerator. Without clear data to guide them, the Fed is choosing the path of caution, of risk management. Think of it like an insurance policy to protect the economy from a potential storm that they can't fully see coming. And this whole situation leaves us with this really fascinating final question about what central banking even is anymore. We're always told it's a science, that it's all about the data, but when the data vanishes and the Fed looks like it's about to do exactly what the market has been screaming for it to do, well, you have to ask, is this still a scientific analysis? Or has it become more of a conversation, a dialogue where the market's expectations are now just as powerful as the economic data itself?